Welcome to Exchange Traded Fridays, brought to you by ETF.com. I'm your host, Paul Curcio, managing editor of ETF.com. And joining me today is ETF.com's superb team of writers and editors. First, we have senior ETF analyst Amit Roy with contributing editor Ron Day. We also have financial reporter DJ Shaw and financial news editor David Tony is joining us for the first time. Welcome, David. And to the rest of you, we have a lot to cover. So let's dive right in. We've got one topic today and a little surprise towards the end. So here we go. The big topic that we've been talking about in the office lately, in our virtual office lately, is that we've been looking at ETFs and looking at where they are now. And rather than review the top stories of the week, we'll be a little more circumspect and have an open debate about the future of exchange-traded funds as an investment class, as inspired by this conversation that we had earlier. Put it in perspective, there are more than 4,000 ETFs already in existence, with more being launched weekly at a record pace. In the US, ETF assets recently topped $11 trillion. It's a lot of money. But we've noticed a trend. Many issues are single stock leverage or inverse ETFs that try and replicate activity of, say, one stock like Tesla, like going 2x on the long side or going short on the inverse side. And then we see other thematic ETFs that are very close in feel to what's already out there, a lot of copycatting going on. So the question that we started talking about, and I'll open to the panel, is this. Is the ETF industry coming to an inflection point after all these years and 4,000 different issues out there to choose from? And where does it go from here?
Conversation here just kicked off with a very healthy debate in our newsroom. We looked at this one filing from Bitwise talking about the first ever GameStop covered call ETF. And my first thought was, are we getting into a race to the bottom for, well, I said the ugliest ETF, but but that's really how it occurred to me that there are some of these funds are getting extremely risky and kind of wild. And then David jumped in and said the industry is kind of veering away, making a hard turn away from its original intent, which is as a tradable mutual fund.
This is David here. I'm noticing something that a lot of these new funds are focused on single stocks, and they're not as diversified as what we traditionally would assume an ETF would be. So I did a quick Google search. I asked Google, what is an ETF? And all of the top results tell me that an ETF holds multiple underlying assets. And while that might be true with the futures and options and swaps, that some of these new leveraged and options-based ETFs, there are technically multiple assets within the ETF. They're all focused on the performance of one single stock. The departure from the role we think an ETF should play in our portfolios, which is as a diversified basket of stocks.
Right, that are tradable. Now, that reminds me of something else that we haven't discussed previously, and that's what about the crypto ETFs? Those aren't stocks at all. Those are assets, yes, but they aren't tradable as stocks. So how does that work as an ETF?
Well, that you could argue that's why Gary Gensler was just so hesitant, and why it took 10 years or 11 years actually for a crypto ETF or a spot crypto ETF to be approved. There was just debate about what is permissible in the ETF. It has something to do with the stake. Some of these issues are also being brought up in the Ethereum ETFs, and what is actually should staking be involved? DJ this morning brought up, I thought was also a very interesting point is, while the leveraged ETFs are this kind of strange thing that goes away from the original intent, he's saying, well, it's kind of giving folks access to some specialized kind of esoteric trading practices that, if you like trading just VU, you might stay away from.
I think what ETFs are about is more so to bring access to a lot of normally be complicated trading strategies. I think it's about access and making things not so overcomplicated. So a lot of like covered call ETFs and single stock ETFs, I don't think they're just financial novelties. I think it just makes things a lot more accessible to average investors. And a lot of these things you would probably not use, and I probably wouldn't use, but the investors that do, I mean, I like to think they're smart enough to be able to say, this is like something that I want to use, or this is a company that I want to short, or I want, for 2 times leverage. I think most people or most investors, hopefully, know what they're doing when they choose those ETFs. And in classic ETFs like SPY still exist and they still dominate. So it's not really, these tools don't really replace that. They just add the option.
So here's the thing that I'm curious about. Has the industry run out of ideas? Have the issuers just either started copying each other, kind of like Hollywood? They make the same movies over and over and over again. Either they stick with a franchise, or if somebody puts out, a Die Hard movie, somebody puts out Die Hard on a train or Die Hard on a bus, and sequels and whatnot, sticking with what they know, or like the music industry of the 1980s, just throw a bunch of bands out there and see what sticks. What value is that to investors, and what value is that, and what kind of ROI is that for the issuers themselves?
Yeah, I don't think the industry's run out of ideas. Clearly, there's a lot of copycats out there, especially in the single stock arena. And that's because it's just such a lucrative part of the ETF industry. These are some of the most expensive products on the market. So when issuers are successful in launching a single stock ETF, they can make a lot of money from that. Versus if you have this low cost, broad market index fund, you're not charging much for that. It's a highly competitive area and it's just not that profitable. So I think that's why you see so many launches in the single stock arena and so much copycats going on there, because there's a lot of money there, especially for these smaller issuers, right? A lot of the segments of the market, the broad markets in the US and Europe, elsewhere, those are already covered by established ETFs, juggernauts that have tens of billions of dollars. There's not a lot of white space there for new issuers to explore. So that's why they gravitate towards these other areas, and why we're seeing just so many launches, dozens, hundreds of single stock ETFs. It's just a wide open space. But to your point, I don't think innovation is dead by any means. You see a lot of copycats, but you also see a lot of genuinely novel ETFs. They're just a much smaller percentage, and they're kind of overwhelmed by, these single stock ETFs and things like that. I mean, I could point to things like the CLO ETFs that were launched just, in the past few years. These are pretty new. And this is a very, popular part of the market now, and it's offering investors exposure to collateralized loan obligations, which they weren't able to get before. The ETF has democratized access to that. Similarly, you have things like the box spread ETF that's completely novel, a money market alternative out there. And then you even have thematic ETFs like the Europe Defense ETF, which we've talked about so many times on this podcast. That launched just several months ago. We didn't have a dedicated ETF that targeted the European defense industry. So there are really, new innovative ETFs that are offering investors exposure to things they weren't able to get exposure to before. It's just kind of being overshadowed by these dozens of other types of ETFs that are launching every day that seem like copycat.
So where does it go from here? Are we still going to have a job covering ETFs in 5 years, or is it going to morph into something different? I mean, we're already seeing things like more extravagant and unusual kinds of elements being added to ETFs
And
to
I
draw in
think that's
investors.
what actually makes our job more important, Paul, right? I mean,
Yeah.
because the strategies are getting more complicated. Initially, ETFs, like you guys were alluding to, were these broad market index-based products, primarily covering different segments of the financial markets. Now it's evolved to the point where that's mostly covered. Now ETFs are packaged strategies. They're more complicated. They often have derivatives inside them. So it's not
They're
as
adding
easy.
private equity, private markets, private credit. I mean,
Yeah, absolutely.
these are things that traditionally you don't think of as something that would go into an exchange traded fund, certainly not into a mutual fund.
Yeah, yeah.
Paul, I think if you think of it like going from only having vanilla ice cream to now having 31 different flavors, vanilla is not going anywhere, and I think we won't be going anywhere either.
Well, I
The
would say
industry is
vanilla chocolate strawberry, but okay.
I was going
Ron.
to say the industry is overwhelmingly ruled by big vanilla. I mean, we have BlackRock and Vanguard have more than $6 trillion, which is more than in assets, more than half of the entire industry. That and so this tiny piece of pie is being fought over by so many companies.
The Tuttles of the industry still
Yeah,
provide some interesting issues, don't they? I think it's a really interesting question. I know that this is just something we're kind of doing a hit and run on today, but I thought it was interesting and worthwhile for us to bring up for our listeners to hear our thoughts on it, because I think the ETF industry really is vibrant and it's been successful, but like everything else, it's evolving. And part of our job is to make note of that. And this may be an inflection point. We'll see. Let's mark it. Mid-year 2025. What happens to ETFs going into 2030? From here, I don't know. Let's find out. But anyway, earlier this week, DJ Shaw talked to a very special guest, as I mentioned, about a new high income ETF that is being offered. So let's listen in.
I'm joined by Tori Cates, co-founder and managing partner of Neos Investments. Neos has been gaining attention for its unique approach to income-focused ETFs, and this year, their Neos NASDAQ 100 High Income ETF, ticker QQQI, took home the award for Best New Active ETF at the 2025 ETF.com Awards. Today, we're going to talk about the fund and the firm's broader strategy around high monthly income and tax efficiency, and what they're doing in spaces like gold and even Bitcoin. Let's start with QQQI. Congratulations on the ETF.com award for Best New Active ETF. What do you think resonated most with investors and the judging panel?
Yeah, thanks for having me, DJ. Happy to be on. So for us, I think what resonated most was the really nice performance that we saw over the past year in QQQI versus the underlying references index, the NASDAQ 100. And on top of that, the tax efficient monthly income that's being paid out monthly to shareholders. I think that, looking at that net after tax distribution being very close to the gross distribution that is annualized on a yearly basis is really important for the shareholders when they get that 1099 at the end of the year. So they're looking at this product that captured a lot of the upside of the NASDAQ 100, weathered some of these more volatile periods we've seen over the past couple of months, and also provided them with some real monthly income during that time. And I think that's what really resonated. And we've also obviously had a nice asset raise over that time frame.
QQQI is positioned as a high monthly income strategy that also offers exposure to the NASDAQ 100. Can you walk us through how that works, especially in a volatile tech-heavy market?
Sure. So if you think about what's in the portfolio, we're basically long the NASDAQ 100 names, all 100 plus names in the same weighting as the NASDAQ 100. So from an equity standpoint, we're not trying to do anything different than track the NASDAQ 100. Where our active management comes in is our active options overlay. We're using NASDAQ 100 index options for the tax efficiency of the index options. As you know, they get what's called a Section 1256 rule from the IRS, which says that 60% of the gains are taxed at long-term cap gains and 40% at short-term cap gains. So it's very different than a lot of other option strategies out there that may use ETF options, single name options, equity linked notes, or swaps. Those are all taxed at ordinary income compared to an index option. So we're taking those index options and we're selling calls on a monthly basis to bring in income. And what's nice about the way we do it, while it's an active fund, it's all rules-based and systematic. So we're looking at volatility and a few other factors that go into deciding not only how far out of the money these calls should be written when we're writing them, but also on how much of the notional of the portfolio should be covered. And that really plays into hitting that target income on top of really trying to capture a lot of the upside of the NASDAQ 100.
Right. You also highlight tax efficiency as a key component of QQQI. What are some of the ways you try to deliver that?
Sure. One of them's what we just discussed, the index options, where you get that 60-40 split, 60% long-term, 40% short-term on the P&L coming off the option portfolio. That's the first way. Another way is harvesting losses. We're not trying to harvest losses within the equity portfolio, how you might traditionally think about it, but harvesting losses through the option portfolio. As we said, it's an active portfolio, but when you have a bull market run or the stock market continues to move higher, especially in these NASDAQ names, you're going to have these underlying NASDAQ built up unrealized gains in the portfolio. And you may have some losses in the option portfolio, even though that option portfolio is providing you real premium every month to distribute out. There could be losses built up, and those losses can be carried forward indefinitely. So as those losses are built up and distributions are going out, if there's at any point when the auditors and the accountants kind of wrap up the year-end numbers, if they could look at it and say at any point that some of the distributions that went out to shareholders were return of capital. I know this is a bigger subject, but we're not looking to return principal, but from a return of capital perspective, from an IRS perspective, if any of those distributions can be deemed return of capital, that just means the shareholder is lowering their cost basis and deferring their taxes down the road to when they may sell the ETF or when they may possibly exhaust their cost basis to zero. And at that point, they're most likely paying long-term cap gains.
QQQI isn't the only area where you're innovating. Let's talk about some of the new ETFs you've brought to market. You recently launched IAUI, your gold high income ETF. What's the pitch to investors there, especially given gold's recent run?
Sure. We really wanted to get this one out. Obviously, given the move in gold, the more focus on gold that we've seen lately, but we wanted to be able to give investors access to having a portion of their portfolio being gold, but some way they could get paid while they own it. So if you're thinking about how do we do this, we have a long position to gold. We do that two ways. One, we do it by owning one of the ETPs that are out in the market, up to a 25% position. And then for the other rest of the long position, we do that synthetically through options. We trade GLD flex options to get that synthetic long. And then we're selling calls to bring in income on a monthly basis. So we look at it as you could have a gold product that might have a little bit lower of a volatility than straight up gold might, and also providing you monthly income where you could kind of get paid that monthly income while you're still holding your gold position.
And a lot of investors think of gold as a defensive asset. How do you balance the traditional role with the income generating strategy you've built into IAUI?
No, it's really important. I think when you're thinking about NEOS in general, on all of our products out there, including our newest one, the Gold High Income product, we really look at ourselves as more of a solutions provider. And we want to be able to slice up your asset allocation into whether it's equities, fixed income, alternatives, commodities like gold. And when we think about it, if someone's looking for a gold allocation, whether that's for a defensive position or just to have some exposure to it in case it does have a move higher like it has recently, we really want to be part of that asset allocation, but also provide real monthly income while holding that position through an option portfolio.
And NEOS also offers BTCI, which combines Bitcoin exposure with income potential. How does this product differ in its use case?
Sure. So very similar to how the gold product works that we just discussed. So BTCI, which is our Bitcoin high income ETF, this one we launched last year, right before the election. So we've had a very nice run up. Performance has been great in that product, and the asset raise has also been great during that time frame. But we do this a little differently than some other products that are out there. Again, to get that long Bitcoin exposure, we have a up to 25% position in one of the ETPs in the market. And then we have a synthetic long using the SIBO Bitcoin US ETF index options, where we build a synthetic long with an option position. And then we're selling those index option calls to bring in income. So this product has a very nice distribution and has had some really nice upside capture versus say Bitcoin.
That brings us to the bigger picture and my final question. Let's zoom out and talk about the broader strategy behind Neos and what ties these products together. Looking across the full suite of Neos ETFs, what would you say is the unifying thread? What kind of investors are you building these products for?
This is a great question. I think we're really building these products for people looking for income. And like I said earlier, we look at ourselves as a solutions provider. So whether you're looking for equities, hedged equity, alternatives such as Bitcoin or real estate or even gold, fixed income or cash alternatives, we're really looking to round out your asset allocation while providing real monthly income from an alternate source, such as an option portfolio. So our fixed income portfolios are enhanced by options on top of them. The goal is to give you additional income over whatever the underlying fixed income is giving you. So for each one of these products, it's really all about income. NEO stands for Next Evolution Option Strategies, and it's all we focus on here is how do we provide, in the most tax efficient way, monthly income to investors.
That's all for this segment, Exchange Traded Fridays. Big thanks to Tori Cates from Neos Investments for joining us. If you'd like to learn more about QQQI or their other ETFs, you can visit neosfunds.com. For more interviews, analysis, and coverage of the ETF space, stay tuned to ETF.com.
Great interview, DJ. And thanks to Tori Cates of Neos for joining us this week. And thanks to all our listeners for streaming or downloading Exchange Traded Fridays. Remember, if you haven't already, please like, subscribe, or follow us wherever you get your podcasts. And if you have a question or just want to share your thoughts, join the conversation with us on X, formerly known as Twitter, where our handle is @ETFCOM. See you next Friday.